Hello and welcome to day number 75 of our Travel Trader series. And as we all seem to have a little bit more time as more and more countries go into a lockdown and that public life comes to a still stand to preserve others from getting ill or becoming ill ourselves or getting in contact with that virus, I thought it's a good time to freshen up some of the knowledge that really helps you in the stock market. One of the things that I want to talk to you about today is a concept that I call cyclical versus defensives. So what are these? In general, we know that we have something that is called the economic cycle, and we're going up and down, up and down, up and down in that economic cycle. And roughly every 6 to 8 years, there is a recession coming where the growth, the GDP growth, is coming down or is negative. A recession is defined as 2 consecutive quarters of negative GDP growth. So that's what a recession is. Now, closely related to these recessions is that some companies, due to the basic of their nature, they are very depending on that economic cycle. For example, if you think about what's going on with the virus right now, travel industry is probably the most impacted industry in the world at the moment because people stop to travel, events are getting cancelled, so they are very, very affected, and that in both ways. So first they are affected negatively, but then after the virus is gone, we will be at a very low plateau from a very low starting point, and then when it ramps up again, the growth will be enormous. And these kind of companies that are very depending on the economic cycle, these are companies that are called cyclical. So that means that when we are entering a recession or a phase like right now where companies are dropping down, these cyclical companies, for example, manufacturing, automotive, everything that comes to a standstill right now is heavily affected and is going down. Therefore, once you understand how you can make money going down, these are the companies that you want to have during a crash because they will crash further than defensive companies, which is what we will be talking about next. So automotive, airlines, everything travel related, manufacturing, again, together with some commodities that are needed to manufacture like steel, aluminum, copper, oil. So they are very, very cyclical, and therefore in a downward cycle they tend to drop faster. On the other side, we have defensive companies. If you think about that, especially right now, health industry, for example, people will always spend their money on health and pharma, no matter whether the economy is going good or whether the economy is going bad. The same is true for, let's say, water, electricity, food. So they are very, very defensive. You won't stop eating for a year just because the economy is in a bad shape. You might eat cheaper food if you don't get as much money anymore. Something you might change or switch from some higher cost to some lower cost. So these will be affected as well. But in general, they won't be affected as much. So their revenue will go down as well, but their business model is quite steady. That means for them that within a downward cycle, they are not crashing down that much. They will go down as well. That's one of the things that we were talking about yesterday, that we are looking for companies that have a stable business model, giving us pretty nice dividends. These typically are defensive companies. And if you can buy them cheap and they go up, you will get huge returns on the dividend over time. So up to 20, 30, 50, 100%, depending on how long you're holding them and what your buying price is. So that can be a huge regular income with a very high percentage basis when you got them cheap after a crash. That's what we were talking about yesterday. If you missed it, just look at yesterday's video. So these are defensive companies. However, when it goes up afterwards, these defensive companies, because they never drop that much and their business model is very stable and predictable, like utility companies, pharma, healthcare, food, and all these kind of things, so they won't aggressively jump up. That's why they are good to buy cheap and hold to get a dividend out of them. And the other ones, after you see that the crash is over and everything went down, you buy them, but they will go up rapidly because they might have a loss or they might report losses in an economic downturn. But once the economy goes up again, then they will typically rise very, very big and they will report new wins, and the growth will look very, very good. If you would flatten out the curve and look over several years, then it's a different story. But from, let's say, one quarter to the next, or from 1 year to the next, growth will look really, really good, and therefore their stock prices will go up very, very big as well. So I hope that's helpful in your decision when to buy which kind of company, and it helps to narrow some things down. If you want capital gain, you typically buy cyclical companies because the chance of them going up like a rocket or something is really, really good. If you want to have cash flow and just some income and don't do anything at all, you will go to defensive companies, and these companies will give you a steady income, and with increasing stock prices, that income in form of a dividend will get higher and higher and higher. So hope that was helpful and a new concept for you, and I'm looking forward to talk to you again tomorrow. We will have a look in the market, and I will give you some more market updates, and over the next few weeks we will do more and more teaching, so we will get you to a different level in how you look at the economy, how you invest, and how you trade. Thank you very much for watching. I wish you a great evening wherever you are. Stay healthy and stay positive. Have a great day, and goodbye.